Let's welcome our market master for the day now. Ridham Desai, Managing Director of Morgan Stanley, joins us on the phone line. Ridham, hi, good morning. Are you spooked by this global sell-off that we've seen, or do you think this is the best opportunity that bulls were looking for?
Good morning, Sonia. No, there's no reason to be spooked. I think it is not out of the ordinary that we get corrections along the way. We had a pretty much straight line market for 2014, so I think 15 is unlikely to be straight line. There will be more volatility, and I think what we are seeing right now is just one of those bouts of volatility.
So Ridham, good morning. So how do you expect the first half of 2015 to be for the Indian markets, keeping in mind with the volatility in the global markets as well as India ahead of the budget?
So I think most of this volatility is sourced outside India. My view is that the India story is shaping up pretty well. We're getting a good dose of reforms. In my view, the growth cycle is turning. The earnings picture will look a lot better in the next couple of quarters. So I think, and inflation should be a lot lower, therefore interest rates will also fall. So essentially the domestic situation looks quite happy for equities. Globally, I think there will be these concerns that will emerge from time to time. And whenever the global trade moves from disinflation to deflation, it will hurt India. I don't think India's macro is past that point where the global picture will not matter. In a couple of years, maybe when our macro is much more robust, it will not concern us. But right now, I think this, I would call it as a deflation scare or a flash deflation scare, is going to hurt in the short run. So these short-term corrections, I think, provide opportunities for investors with a longer duration, longer investment horizon to buy stocks. And that's our view, and I think that's pretty much what could happen in the first half. Indeed, as we go later into the month of January, the market's focus will shift to the budget. And as usual, February is a good month for the market because the market builds up in anticipation of the budget. So it's unlikely to be different this time. So I think this correction will be forgotten by then, and we'll be anticipating a strong budget, and the market will respond accordingly.
Okay. There is one more view in the market, Ridham, that the returns on equities globally will be much lower in 2014 compared to what we saw last year, purely because of the lower growth projections that are underway.
Sonia, I would want to actually differ with this lower growth story that is floating around as a consequence of lower oil prices. That is, a lot of media commentary is centered around if oil prices are down, that means global growth is bad. But actually, if you look at the global macro data recently, it's not been that bad. It's actually improving. So I think global growth will be okay. It's not about to register a new, fresh down leg. And oil prices are going down as a consequence of excess supply more than slowing demand. So I don't think it automatically translates into lower growth or does not imply that growth is lower. If that is the case, then I think it's a pretty benign situation for India, which is a kind of range-bound global growth, soft oil prices, and therefore kind of flattish interest rates globally. That would be the best scenario for India in 2015. So I think, I don't know about global equity returns. We think that they should be, they're likely positive. That's our global view in 2015, but a little lower than 2014.
Okay. So Ridham, would you still recommend buying cyclicals, financials, or given that 2015 might be more of a volatile year, defensives might, look a little more attractive if someone has to, make use of this opportunity?
I think people should continue to invest in banks, industrials, consumer discretionary. So I think we are certainly bullish on cyclicals. And these corrections do provide opportunities to buy them cheaper.
Okay. Just coming back to that point you made about lower oil prices, I take your point completely, Ridham, that, lower oil prices, of course, in the longer run will be a huge benefit for markets like our own. So how do you play this theme in our own markets? Do you continue to buy, some of these sectors like oil marketing companies, paints, tires, etc., that benefit from lower oil prices? Or do you think that story is done?
No, so there are two ways of analyzing this, Sonia. One is the macro benefit that oil brings to India. So it reduces our current account deficit, it reduces inflation, it boosts growth. That creates a better macro environment, and the biggest beneficiary of that better macro environment are banks and industrials. The second is the micro benefit, which is in all the sectors that you mentioned, companies that will experience lower costs. In my view, a lot of that trade is already in play, whereas the former trade is not necessarily in play. So, for example, I think industrials could be a big beneficiary out of a better macro, and that is not fully priced in. So my bias would be to buy the banks and industrials rather than buy the direct beneficiaries at this point in time.
Okay. Since global is the only risk for the Indian markets, how worried should we be about what's happening in the globe? Is the environment such that it could result in about a 5 to 10% correction from here on, just purely the global developments?
Yeah, I mean, it's hard for me to tell the next 5% move, and it could go lower, it could stop here. That's very hard to tell. But yeah, the world is a bit unsure right now. That may change in a month from now. So I think those short-term calls are very difficult for me to make, and I'm really not an expert in making those short-term calls. I think the medium-term outlook for Indian equities looks very solid. And when investors get opportunities, when stock prices are lower, I think they want to buy that opportunity rather than sell it. You always keep some powder dry, because you will get volatility along the way, which will create opportunities.
Yeah, I think this was the best reason to keep the powder dry at times like this, when you can get prices at lower levels. But you were talking about some sectors, Ridham. I just wanted to flesh that point out further. We heard from the coal secretary a couple of days ago, and he mentioned that Coal India's production will go up quite a bit. A lot of the rail linkages issues are being sorted out, and the power infrastructure sector will be a direct beneficiary of that. Would you take a look at any of these sectors now to buy?
See, I think you're making a very good point, Sonia. This is precisely the issue, which is that India's macro is improving despite, say, the lack of any headline news. There's a huge amount of work that's happening underneath. And the point that you made on coal production is a very valid one. The turnaround that has happened in the last 6 months is remarkable. And Coal India is now producing at a faster clip than it has done in recent years. That goes a long way in improving India's macro. So, of course, investors can look at these idiosyncratic developments and make stock picks. But ultimately, the net impact of this is that the macro gets better. And when the macro gets better, I think banks, industrials, and discretionary consumption do well. So I prefer to do that rather than delve into the minute details of each idiosyncratic improvement and try and buy stocks on the back of that.
Sure. Just one more question on how you would approach the IT space now, because there's been a clear underperformance over there. I don't know whether it is to do with the expectations from earnings or in general because people are more bullish on the domestic economic recovery. But how would you approach this space?
So I would actually continue to be very constructive on that. We are overweight the technology sector. I think the demand conditions from the US are likely to stay strong, and we're also bullish on the US dollar, which means that there will be currency tailwind for the tech companies. So I think beyond this quarter, things will look a lot better for tech companies, and therefore, if these stocks have gotten cheaper, I think they are better buys now. So we continue to stay constructive on technology.
Yesterday, we got a very large sell figure by the FIs in the cash market. In your conversation with investors, can this selling pressure in the cash markets continue? Are ETFs looking to reduce their position in India, or this was a one-day fall and aberration?
No, as I said earlier, Rima, I cannot be really precise about these short-term forecasts, and flows on a daily basis are very hard to foretell. So I would hesitate to do that. But I think the general mood on India is quite positive. I think investors globally are looking to add to India, not take away money. What they do on a daily basis is very difficult to tell. But I think over time you will see that foreign investors will buy more of India. If anything, I think there's a free float issue with India, which is that a lot of stocks they want to buy are all capped out on FI limits. And that, I think, could become a bigger problem as time passes, which needs to be redressed both by policy as well as by companies. But generally speaking, I think the sense I get is foreign investors are looking to buy India.
Okay, just one final question from my end, Ridham. You know, with the previous government, we were so used to having high expectations from the budget, so the market generally ran up in anticipation of the budget. But this time around, a lot of work is being done outside the budget as well, as the finance minister pointed out, with the land, coal, ordinances, etc. In that sense, do you think that the budget itself may not be such a big event to watch for?
That's a very good point. I think there's a lot of work that will happen before the budget. So I think that will continue, which in itself will probably help share prices. So therefore, share prices could actually rally in the next 7 or 8 weeks in front of the budget. The budget itself, in my view, will be more about fiscal consolidation, about going towards GST, and I hope to see some infrastructure allocations. But before that, I guess a lot of work would have already happened outside. So that will help share prices, in my view.
Okay. And just, one final question then from my end. You recommended that, you like the banking space. Would your preference still be for private sector banks, or given the work that the government is doing, the Gyan Sangam, PSU banks, the risk reward is now tilting in favor of PSU banks versus private?
No, I think it's a function of time frame. So if you take a medium-term view, we still like the retail private sector banks. If you're taking a 6-month view, then I think wholesale banks make a lot of sense, because interest rates have peaked and they will start, or they've actually already started declining, but they'll probably decline a bit more, and that usually helps the wholesale banks. So on a medium-term basis, the private sector banks; on a shorter-term view, the wholesale banks is what we prefer.
All right. Thanks, Ridham, for joining us this morning and giving us your view. The market, I think, has taken cue from that and has moved into the green. But let's see whether investors take forward your point. So that's the word coming in from Ridham Desai of Morgan Stanley. They believe that the Indian macros are far too strong and on a recovery path. So don't worry too much about the global jitters.